All right, welcome everyone. Thanks for tuning in to this episode of the Hawaii Retirement Show. We got a special guest on today to talk about market and economic cycles. We have Darcy Smoot of Nelson Capital Management. Darcy is a chartered financial analyst, and I'm really excited to have her on and jump into this conversation. Darcy, I'll turn it over to you if you want to tell our audience a little bit about yourself professionally and your background.
Yeah, thanks, Jason. So as Jason mentioned, I'm with Nelson Capital. I'm actually the third generation of the firm. So it was founded by my grandfather, Phil Nelson, in 1975. So we just had our 50th anniversary last year. I joined in 2014 along with Evan Nelson, my brother. And then Brooks Nelson is our dad. He's also still working at the firm along with a long-term partner, Steve Philpott. We manage about 750 million in assets under management for about 150 client families. And a lot of those clients are clients that we've had for multiple generations, which has been great. So I've been there for over 12 years now, which is hard to believe, but really happy and love working with clients.
Yes, and you're a chartered financial analyst. And for some of the listeners who might not know, the CFA designation, I just have the utmost respect for it. That curriculum is no joke. I'm sure there's a lot of talk back and forth of what is the hardest, you know, exams out there, like the bar exam, you get your CPA, all this other stuff. I'm just the CFP, but the CFA, hands down, in my opinion, whenever I see somebody with those three letters, I tip my cap because I know that is no small task.
Well, thank you. I appreciate that. It was a lot of hours put into studying. Actually, what was nice was actually my husband was studying for the bar exam while I was studying for the CFA exam in 2015. I was studying for level one. So it's, three levels. And at the time it was offered once a year. I think now it's offered a couple times a year for the various different levels. But yes, many, many hours went into studying for that exam. And it was great because I think it really provides a foundational background for, analysis of companies. And I think that's important when you're making investment decisions. I think that the creators of the CFA program looked at, you have to go to medical school to become a doctor, you have to go to law school to become an attorney. There's really nothing like that to, give to do investment decision making. And so I think that having those three levels, those three tests, those many years of studying was really helpful. And actually, that was my first role at Nelson Capital. Now I work with clients. I direct our research team as kind of the chief investment officer. But I was on the research team with no client responsibilities for the first half of my career.
Gotcha. Very cool. Okay, so I think today we're going to talk about economic and market cycles. And I just want to preface with we're not trying to make any projections, predictions, not investment, legal, or tax advice, purely educational. But I kind of want to just kick it around and kind of hopefully give the listeners a better understanding of how economic cycles and market cycles are different, how they might overlap in some ways. And yeah, just the whole gamut, whatever we get to here. I guess another thing to preface the conversation with is we would all like if things just moved in a straight line, right? Market cycles, there was no volatility, economic cycles. Unfortunately, it's the system we have created here, the financial system, is kind of predicated on cycles, right? And it's not necessarily a bad thing. Economically, I guess, and with the market, it's to be expected. So I guess just to kick it off, can you kind of give us a high level differentiation of what I'm even talking about when I talk about market cycles versus economic cycles?
Yeah, absolutely. So I think, economic cycles, we look at different take the temperature essentially of the economy. And that can be measured in a lot of different ways. The primary marker is gross domestic product, or GDP. So basically that's the measure of what is the growth of the US economy. That's kind of the best answer, is let's look at GDP. And GDP is fueled by a number of things. It's about 2/3, consumption. And that's where you get into kind of the other indicators that can go into an economic cycle, because who are consumers? Well, in the US, it's us, it's Americans. And so, what allows consumers to consume is whether or not they are employed and have, funds to do so. And I think there's a little bit of, sentiment, and do they feel like consuming and spending? And of course, then we get into, well, can they do that with if they are gainfully employed? And a lot of then that, we look at inflation. Is the cost of goods and services at a level that is palatable relative to the wages that people receive? So, I mean, that's kind of a very, very broad view of what is the economy, and what is the economic cycle. Of course, mentioning all of those different markers of the economy, we've seen cycles in the recent past. We had a pandemic that was a shock to the system, an exogenous shock to the system that really it disrupted everything, but obviously huge layoffs and a huge loss of jobs kind of overnight, especially for a lot of the service industries. Those people found themselves without jobs, and there also were no services to consume. And then, since that time, 6 years ago, we've seen the cycle kind of go the other way, and an enormous period of growth subsequently. So, that those economic cycles are, they're almost a given, but they're very unpredictable as far as when they occur. And whether or not we see an exogenous shock like the pandemic, or something that's a little bit more, I would say, predictable in terms of the Federal Reserve and interest rates and those types of factors influencing the economic cycle. Again, it's hard to predict, especially the exogenous shocks. We try to follow those very closely. But the timing of when the ship turns around with the economy is always hard to know. It's just, you have to kind of keep an eye on these different markers, and try to see what you think the projection is. But the market, I think, as you pointed out, or probably have pointed out on this podcast, is very different. It also goes through cycles, but that's much more sentiment driven. So the stock market is not trading directly on what is happening with the economy. It can often kind of be dislocated from it. We like to quote the John Maynard Keynes quote, which is that bull markets are born in pessimism, develop in skepticism, mature in optimism, and die in euphoria. So, if we think about a bull market and a bull market meaning stocks are rising, a bear market meaning stocks are falling. Of course, the stock markets and bond markets go through these cycles as well, but it's really more sentiment driven. It's kind of what are investors' expectations for the economy, and therefore the earnings of the companies that they're investing in.
Yeah, I love it. That was a great high level kind of analysis of it. And I think it's interesting. So through monetary policy or fiscal policy, we can kind of tinker with the economy, right? We can kind of pull some levers to maybe, you know, get a desired response in the economy. But no such tinkering exists with the market. It's kind of its own beast that's going to do what it does, right?
Yeah, that's very true. And I think one of the ways that investors can, you can't really go look at a stock or a S&P 500 index and say, is it a good deal?
Right.
But one of the ways you can kind of ask that question is by looking at a valuation metric, whether it's price to earnings or price to sales. We look at forward price to earnings because that will include forward looking, analyst and company projections of what earnings will be. And we try to look at the price of those companies relative to that. But yeah, there's not a great way to know, because I think people, things can stay expensive longer than you expect them to, and they can stay cheap longer than you expect them
Right.
to.
But I guess I'm thinking about it a little further here with the tinkering. So monetary policy would entail the interest rates, right? The Federal Reserve interest rates, which really and you know this better than I do. I'm kind of trying to get through it the best I can here, but that's going to set the rates for lending from banks and other institutions. Kind of trickles down. It's not like a one for one rate, but
Yeah.
um, but I guess those interest rates, it doesn't impact the equity markets, but those interest rates, those tinkering of interest rates will impact strongly the bond markets, I'm assuming, right?
Mm-hmm. Yeah, definitely.
Okay.
Yeah, the Federal Reserve sets the overnight, target rate for which, it's kind of in the rate itself doesn't directly impact, individuals like you and me. It's really the rate at which banks can lend overnight to one another. But it serves as a benchmark for a whole bunch of other rates. So, when and it's interesting to kind of think about this in the context of the last decade or so, because post financial crisis in 2008, we went through a zero interest rate world where the Federal Reserve recognized that we were going through a significant downturn in the economy, in conjunction a downturn in the stock market. But the economy is what they're more concerned about. They saw huge spike in unemployment, and a decrease in growth, and they said, you know what, we got to stimulate the economy, so let's bring interest rates to zero.
Mm-mm.
And effectively, they stayed there for a very long time. And in fact, that was, historically, interest rate, setting that target interest rate is the Federal Reserve's kind of only tool in its tool belt. After the financial crisis, they went through 3 rounds of quantitative easing, which is where they effectively used the Fed's balance sheet as a new tool. And that hadn't really been done before. The Federal Reserve's balance sheet had been pretty stable at just below $1 trillion prior to that point. But the Federal Reserve went out into the open market and purchased bonds, putting money into the system and then putting bonds onto their balance sheet. And their balance sheet went from about 1 trillion to 4.5 trillion. And the idea was, get the money out into the economy, kind of the modern day equivalent of a printing press, to try to stimulate the economy that really had been so damaged by the financial crisis. And I think what happened was, you had a lot of this money that went out into, was supposed to go out into the economy. And maybe some of it did, but I think a lot of it really went onto balance sheets of investors. And I think it's, there's a whole rabbit hole we could go down determining that. But the point is, the Federal Reserve now has two main tools, which is to control monetary policy: its benchmark target interest rate and its balance sheet. After the $4.5 trillion, we had it kind of stable there. The Federal Reserve actually started to reduce the size of its balance sheet and hike interest rates. And then the pandemic happened, and they brought interest rates back to zero. And actually took their balance sheet from $4.5 trillion to $9 trillion. So that was really significant, and a concern about what does this mean for the bond market, our country in general, our monetary policy. It seemed like
Right.
We kind of had to throw the whole kitchen sink at it. But again, since that time, we've seen a stabilization in the U.S. economy. the Federal Reserve has actually been successful at reducing its balance sheet to about, I think, 6.5 trillion or so, which is good. And they're now at a place where they're trying to manage, of course, their dual mandate in the economy, the signs from the labor market, are people still employed, and from the inflation side, because the risk, of course, is if rates are too low and the Fed stimulates too much, we get runaway inflation.
Gotcha. Yeah, and I guess so the Fed is not really concerned with what's going on in the stock market itself. They're focused solely on the economy.
Yes.
Um,
Now, they may have stock portfolios
sure,
themselves.
sure. Right. And then I guess the other thing, which well, I don't want to go down that rabbit hole too much, but those interest rates will determine, well, at least help to determine the returns from treasuries, right?
Yeah.
And treasuries kind of, not to get too deep in the weeds with the on your stuff, which you know way more than I do, they'll help determine the risk-free return is what they call it, right? And so that kind of I guess impacts how stock and bond prices would react, right? Because if you can get this risk-free meaning it's just backed by the US government. I mean, I
Mhm.
guess there's no such thing as absolutely risk-free, but it's as close to risk-free as possible. Then for everything else that you're going to invest in, you kind of pay a premium over that risk-free. Is that a good way of
Yeah, that's
simplifying that?
exactly it. Yeah, exactly right. So the Federal Reserve, when it borrows, and if you as an investor are buying a treasury bond, you're lending to the US government. The US government guarantees that they will be able to pay back that principal. Effectively, they say, if we don't have the money, we will just print it
Hmm.
and add to their budget deficit, basically. Um, so what does that mean? Well, there's no credit risk, because when you invest in a bond or a bond type instrument, essentially when you lend money, there are lots of different types of risks out there. One of them is credit risk. Will I get my money back? When you invest in a treasury, lend money to the US government, you will get your money back. If you lend to an investment grade company like Microsoft, you're very likely to get your money back, but it's slightly higher risk than the US government. And so there's something called a spread. And it's a spread to treasuries where you consider treasuries to be the risk free rate. And then investing in Microsoft might be a little bit more risky. So you get you as a lender demand a slightly higher yield for that investment. And then you can kind of go out from there. Maybe there's like some neighbor of yours that really never has his stuff together and needs to borrow $10,000. If you're thinking about doing that, you'd want to demand a pretty significant premium above, a treasury, because you're not really sure you're going to get your money back.
Mm.
So there's really a spectrum of credit risk. And then again, similarly, not to get too into the into the weeds on bond investments, but there are different terms at which you can lend money. If I'm going to lend money for 3 months, I'll get a particular return on that investment. If I'm lending money for 10 years or 30 years, I'll get some other, annual yield or return for that investment. And traditionally, when you look at, if you were to plot those yields at different, borrowing terms, so say 3 months, 6 months, 9 months, 1 year, 2 years, 5 years, 7 years, 10 years, et cetera, you'd get what's called a yield curve.
Mm.
And the yield curve is very dynamic. And in fact, the short end of the curve is very much dominated by whatever the Federal Reserve decides to do with their benchmark interest rate. What's interesting, and as we mentioned, that flows through to lots of other types of borrowing, credit card interest rates, car loans in some regard, um, uh, um, pledged asset lines, et cetera. Like lots of different interest rates are tied to that Fed overnight rate. Mortgages are a great example of something that doesn't fall into that bucket specifically. Mortgages are longer term. When you borrow money to buy a house, it's traditionally, say, a 30-year fixed mortgage. mortgages are much more sensitive to what's happening on the 10-year Treasury yield. And that's a little bit interesting because, it will certainly be influenced by what's happening on the short end of the curve with what the Federal Reserve is deciding to do. If the Fed sees this pandemic hitting the economy, they take interest rates to zero. Certainly, I think the 10-year Treasury also came down lower because effectively the bond market is saying, there's a growth problem here. We don't see super high growth happening. We also don't see any risk of inflation. That yield is going to come down lower. But again, that is dynamic. And often last year, we saw the Federal Reserve cutting rates. And actually we had clients saying, am I still getting a 6% quote for a mortgage? And it's because it's tied to that 10-year Treasury, which has somewhat different drivers that impact it.
I'm so happy you're here to articulate that. In my head, I can follow and I get it, but it's so great having somebody who can articulate that. And I think that's a super common sentiment amongst the broader population, especially in the real estate market right now. Is I think there's a lot of people seeing interest rate movement on the news and saying, "Hey, what's the deal with the bank telling me it's this interest rate?" Right? There's kind of the disconnect, and that's a great way of thank you for articulating why there is that disconnect there.
Yeah.
Okay, so let's jump back to market economic cycles. So we know the economic cycles are the economic indicators. You got leading indicators. You got what else is there? I guess there's I don't know past indic. I know there's some
Lagging indicators.
lagging
Yeah.
indicators. Okay, right. So we have like inflation. We got GDP. We got the labor markets.
Mm-hmm.
Looking over to the stock markets, the
Mm-hmm.
market cycles there. Um, there's not the same kind of indicators, right? There's not, I mean, there's the valuations, and I think I would guess the overwhelming majority of retail investors aren't looking at the valuations. It's more the institutional investors, the professionals like yourself, who are kind of actually looking at the metrics.
Mm-hmm.
Otherwise, people are kind of just going off of the retail investor, just going off of how they feel, right? And I guess you just call it speculation, right?
Yeah.
Okay. Is there any indicators? Anything that correlates to that like inflation, labor market that you see in the stock markets?
Yeah, that's an interesting point. I think from our perspective, you can really come at a stock market investment a couple different ways. Um, One is bottom up approach, where you have a universe of equities or stocks, and you say, okay, I'm just going to look at those that have the fastest earnings per share or EPS growth, that have the fastest revenue growth, and those that have maybe a valuation that is on the lower side, and I want them to pay a dividend. And you can say, okay, those are the types of investment. That's what I want to make up in my portfolio. And that's really looking on a micro level at what is on that company income statement, cash flow statement, balance sheet. We take a little bit more of a top down approach, which I think is probably more common among advisors. And maybe it's a bottom up approach that might be more common among retail investors who say, I went to Costco the other day. It was great. I love the company. I want to buy some stock, which again, it's not a bad way to invest necessarily. It's just, I think any investment you want to think about with context. So, and that's where I think the top down approach really allows to think through that context. So with the top down approach, you do sort of set the stage by having the conversation about where are we in the economic cycle? Are we in a period of growth? Are we in a period of contraction? What is going on externally that could change direction of whatever direction we're currently going. And then from there, I think that can direct your conversations about when you get more granular. Let's say, I'm going to set international aside for a second
Sure.
and just say we're focusing on what do we want to invest in the US stock market. If we are in a period of economic growth, that's what we've determined in our analysis, then what do I want to invest in? Well, probably consumer discretionary, which is things that consumers buy on a discretionary basis. Um, Probably technology, which is kind of a growth sector that does well in periods of economic growth. Um, and probably energy, maybe financials. Banks are actively lending because companies are growing, and that's a positive for the economic cycle. On the other hand, if I have identified that we're in a period of economic contraction, then I want to look for more defensive sectors. So maybe I want to look at healthcare, which people will have to pay for regardless of what their wallets are feeling like. Consumer staples companies, that again, these are things you're buying them whether you feel like you have the money or not. And then maybe utilities. So there are different sectors within the US stock market that tend to do well in certain economic backdrops. So I think that is how you can kind of do that top down investing as an, you can do this as a retail investor too.
Mm.
But from there, then I think within each sector, again, very realistic choice could be I'm going to buy an ETF that it expresses my view of wanting to own the US stock market or wanting to own the energy sector in a little bit heavier weight relative to the US stock market. Or you can decide to invest in individual companies. Not a plug for Nelson Capital, but that is actually what we do on the US large cap side of things. Is we build a portfolio across the various sectors of the S&P 500, but made up of individual securities.
Very cool. And I think would you agree that uh even for professionals, I think it's so fascinating how you take this approach and you're obviously you have the pulse, you're as smart as well equipped as anybody else out there to make these decisions. And I'm sure even then there's humbling moments of things zig when they should have zagged, right? And
Mhm.
you're is in the end you're just it's like baseball, you're just trying to bat, you know, 300, like you're gonna miss, right?
Absolutely, yes.
Does
The market can stay irrational longer than you can stay solvent, is the famous
right.
quote. Which, and I think that that's especially true. And it's like there are times like right now, in fact, when we are seeing sort of conflicting views on one particular theme. So with AI, for example, um, the there's two views right now that again seem fairly conflicting. On the one hand, there's the view that the hyperscalers, Amazon, Meta, Oracle, Alphabet, etc., have invested way too much. They've basically taken the fortress balance sheets and billions of dollars of cash that they had on their balance sheet, plowed it all into these investments in data centers to build out their AI capabilities. And where's the ROI? That's not going to pay off. On the other hand, there's a concurrent argument that AI is going to be so good that it's going to displace everything. And so
Right.
if those two things are both true, they seem conflicting, right?
Right.
Because if AI is going to displace everything, then these hyperscalers should be putting all their money into these different capabilities. But so it can be really difficult to navigate something like that, where you have, you might have a belief, but the market just doesn't have that belief at this time. And so you might think something is very attractive and looks good and has a, nice runway, and it might even perform really well in terms of its earnings, and it might grow like you expected it to. But for whatever reason, the market discounts it because who knows? The market can be irrational.
Right, right. And I guess it's a good time to point out that, speculation isn't a bad thing, right? I mean, sometimes, like you said, you have some of these the Mag 7 that might be trading way over what their books or whatever metrics you're using. and
Mhm.
that could be completely justified if it lands and things work out.
Mhm.
Um, yeah. So, is there any is there any concerns about the concentration in the market? Would you say?
Yeah. Yeah, and yes, absolutely, 100%.
Okay.
And in fact, that was one of we do a quarterly presentation, economic overview every quarter that we publish and send to our clients and publish on our website. And the last one that we published was diversification in an age of concentration. Um, and what we've seen is with the rise of the Mag 7, if you just kind of keep it simple with top 10. So the top 10 holdings in the S&P 500, again, a basket of 500 stocks,
Right.
the top 10 make up about 40% of the entire index, which is mind-boggling. And I think we've experienced periods of concentration before, not recently. I think that the data says that the last time we saw something this concentrated was in the 1960s. But when we were, at that time, the top 10 companies were in diversified sectors and industries. This time, they're kind of all levered to the same theme.
Mm,
And that is sort of gives us extra cause for concern. Now, we do hold some of the Magnificent Seven stocks within our portfolio. But again, one of the reasons that we create custom portfolios with individual stocks is that we can decide not to own Meta, for example, or not to own Tesla because it's simply too volatile. And that I think it's there are reasons aside from concentration that we don't own those two companies, but the the concentration is a big one, and it's a reminder that it's important to diversify. And just holding the Magnificent Seven would have been a great strategy for the last couple of years, but that's not a strategy because it exposes you to an increasing level of idiosyncratic risk.
sure. And and just looking at, where we are currently, right? We're talking about the concentration in the markets, but it's also been a great time to be an investor over the past, what would you say? I mean, since
Mm-hmm.
since 2008, because even the
Yeah.
those downturns, the pandemic, there's probably another one I'm missing, and they're kind of quick to recover. Um,
Yeah.
and I wonder if that is going to lead to maybe a little bit overconfidence from all investors. Or here's the interesting thing about the markets is that's why it's so fascinating because it's a story that will never end, and you don't
Mm-hmm.
know the answer. And you could say, well, it's been too good, and so we'll revert to the mean.
Mm-hmm.
And that could never happen. Maybe we're just rewriting, the history, the context, the means. But yeah, I find that fascinating that right now, I mean, we're just in this period of, I think they call it a secular bull market, right? A very long and it doesn't show any signs of stopping. Even what we have going on right now with over in the Middle East, not to get into that, but I mean that's having its impacts and it just seems like the markets just keep on ticking on right now.
Yeah, that's a really good point. And I think there are reasons to be very positive from a secular perspective on the US stock market and the US economy, but really the stock market, because the companies that have dominated the S&P 500 for the last 10 years, I would say, they have consistently churned out better growth.
Mm,
So it's a good thing to invest in better than the average S&P growth. I will say though, what's kind of interesting about like you pointed out, we've had back-to-back years of 20% plus annual returns in the S&P 500 in stock markets. Um, Even 2020, people forget the market was still up like
mm,
18 or 20%, something like that. Um, we used to look at consumer sentiment, and when it's really low, we would say, this might be a negative economic indicator or negative market indicator. But it has been so low for the last 3 years, to the point where the latest reading in February of 2020 of this year, so last month, it was at 56.6. Just to give you some context, if we were to look at the last 50 years, so since the 1970s, the average is about 77 and a half. And April of 2020, the depths of the pandemic, the consumer sentiment reading was at was higher than where we are now. So
Interesting. Yeah.
it's very strange to have people feeling so anxious when we've had really great market returns. But I think, like the war that we've seen in the last couple of weeks that kind of came out of nowhere, but as a surprise to the markets. I think we're seeing a pretty significant reaction because there's so much anxiety or jitteriness, and any kind of uncertainty like this tends to rattle the markets. And that said, geopolitical events have historically been good buying opportunities. We don't know if this one is, but
Right, right.
historically we've seen the market recover relatively quickly.
Interesting. Yeah, and again, this just kind of goes back to the market is such a difficult beast to wrangle
Mhm.
and time. And I always say, if you're invested in the market, that timing the market is extremely difficult because you got to be right twice, right? You got to be right when you're going to get out and then get back in, or vice versa, when you get in and when you get back out. It's such a hard thing to do, especially with these black swan events, and there's always another one coming.
Mhm.
Yeah, it's just a fascinating thing. So let's switch gears. I work with a lot of people approaching retirement or in retirement,
Mhm.
and a lot of times their goals with investing switch, right? They're no longer in the accumulation phase, kind of chasing alpha, so to speak, and we're kind of managing capital. Not for everybody, but that's kind of where they go. And I am a big believer in, the efficient market hypothesis and passive investing and broadly diversified, ETFs, mutual funds. But I will concede that all that only works if there's active participants to make the market efficient. Am I correct there? Because some people there's a sentiment of if you're investing the way I just laid out that there's no place for active. But I would argue the efficient only works because there are people chasing the alpha like yourself and who are actively you know looking for those advantages, right?
Yeah, I think that that's a good point, and there will always be. I think the markets, the information, um, the ability to get information has only improved, and that makes the market efficient because we are going to get the latest and greatest from every company as soon as it's published or on the at the newswire tweeted or whatever it is. um and I think you bring up a good point. We also love the fact that there's been this explosion of passive vehicles that are very cost efficient, because you can get access to a particular market for a very low cost. Decades ago, that was really not the case. You either, I mean, even predating ETFs, there were mutual funds, which was the first kind of pooled investment vehicle that was easy to buy and traded, and you could buy a share of a basket. But even at the time, that was kind of revolutionary that you didn't have to buy 500 different stocks to get exposure to the S&P 500. So the fact that we've seen that evolution has been really remarkable, and I think really great, especially for retail investors who don't have time to do
Right.
company deep dives and bottom up research on companies. They can simply just buy an ETF for a very low cost. But I think you make a good point. Whenever there are gazillions of passive vehicles out there, and I think there's an active decision that still needs to be made about which vehicle do I use and what's the mix of diversified passive vehicles. So,
Hmm.
for example, as you mentioned, a client that you had that's exiting the wealth accumulation phase and entering the wealth preservation phase as they retire, they're probably not going to want to have a fully 100% equity stock portfolio because that's probably too high risk for them. And so there needs to be a decision from you and with the consult of the client to determine what is the right asset mix in terms of the stock market and the bond market. Bonds are a way to insulate the portfolio from some of that volatility. And then even beyond that, do you invest in 100% treasuries on the bond side and 100% US? Do you have some international? How much? Do you have any small cap? So I think those decisions are really important. And I think that's a big value add that I think you probably provide to your clients.
Sure. And then diversification, it has a very positive connotation and most people out there are very familiar. Yeah, diversify.
Mhm.
Um and these big, ETFs, these big pooled investments allow you to do such. But I think it's worth pointing out, in my opinion, that diversification isn't always a good thing. It's not a positive thing because you could diversify with a low returning asset, in exchange for maybe stability within a portfolio. I just think a lot of times people think, well, diversifying, but I would just caveat it with saying, well, diversifying doesn't mean, you know,
Better always.
better, right? Am I
Yeah.
correct there?
Yeah. Well, yes, because you never know, right? And I think I have a friend who has told me she's not a client, but the friend who mentioned she's a longtime Apple employee, and she said every person who's told her to diversify and sell her Apple holdings, she's listened to, and it's been a bad decision.
Right,
And
right.
that's because it's just been a very durable stock that has gone up. And I think when advisors tell clients it's a good idea to diversify, it doesn't, like you said, it doesn't always mean your returns will be better, but they will be better on a risk adjusted basis. And what that means is, by holding 100% Apple in your portfolio, looking back historically would have outperformed, maybe a diversified basket of securities, but you're exposing yourself to more significant amount of risk if there's something that happens to Apple specifically that causes the stock to fall, which is, it doesn't feel as realistic with Apple,
Right.
but you could use a more extreme example with Enron. People who were companies or employees of Enron, that was their whole, they participated in the ESPP, they had RSUs, they had a significant amount of their net worth tied up in that company. And all of a sudden, overnight, it's evaporates. And so that's the sort of scary boogeyman thing that could happen. That is idiosyncratic risk, the risk that something happens to that single company. You really don't want to expose yourself to needing to change your lifestyle completely or losing all your savings. And that's where diversification is helpful.
Sure. And so somebody with so that we're talking market cycles, somebody with a diversified portfolio, and we're talking market cycles and how there's a lot of challenges around market cycles, and there's always going to be ups and downs. One of the great tools in our tool belts, both professionally and for those, retail investors, is rebalancing, right? Because rebalancing offers a way of systematically buying high and selling low, right? Like it it kind of chops off the highs and chops off the lows. Do you want to just touch on, the benefits of how rebalancing can fit into combating, drastic market cycles, I guess?
Yeah, definitely. I think it's really important to rebalance because when you look at all your finances and look at your portfolio and decide this is the right asset allocation, for example, I'll just start with asset allocation to begin. We
Sure.
say, okay, I'm entering retirement, so I should have 60% equities and 40% fixed income. And then we have 3 years go by, you haven't looked at your portfolio, the stock market's done really well. Now, all of a sudden, you're at 80% equities and 20% fixed income. Well, that's not the intention that you had when you looked at this, and it sort of exposes you to more risk than I think you probably want, especially if you're retired. So that in that case, you're selling some of the equities that, again, like you said, have done really well, are up, and redistributing, rebalancing, and putting those funds into the bond market, into fixed income. And I think it's a really good discipline that, advisors look at client portfolios every day to see if there's deviation from that model that you set up, or that asset allocation that you set up. But it's really, if it's not your day job, it's hard to remember to do that, honestly.
Right,
And I
right.
think people have really good intentions and say, I want to, like, I'm getting serious looking at my finances. But if you 3 years down the road, or even 1 year down the road, you might have an issue that something has drifted away from what you originally intended, and it's created a risk issue for you.
Gotcha. Well put. I was going to ask you to put on your business news hat and give us a unreasonable projection on the future and where we are, but I think unless you want to, I'm not going to hold you to that because it's just too hard
An
too hard to say.
unreasonable projection. What would that be? Yeah.
No, but
Um,
I appreciate it. This is all great stuff. So we covered a lot here. Yeah, and it's just so interesting. The economic cycles, I think it's important for those listening, and there's all different aptitudes listening to this, and you might think economic and market cycles are tied together. And I think the takeaway is yes, sort of, but not really.
mhm.
Is that a
They
fair takeaway?
influence one another, I think.
Okay, gotcha.
Yeah.
Awesome. Well, Darcy, I really appreciate you coming on. Thanks for
Mhm.
taking the time. Darcy Smoot of Nelson Capital Management. She's a CFA. Darcy, if anybody wants to find you or reach out, is there a website or anything?
Yeah, nelsoncap.com is our website. Mm, they can find me there. We have an email contact on the website as well. And I really appreciate you having me. Thank you, Jason. It's great to chat with you.
Awesome.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by Toba Financial. For Jason Cutitta, investment advisory services are offered through Toba Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.